Welcome back to the Rob Berger Show. We are continuing our series on Morningstar and how to make the most of it and help you become a better investor and at least try to figure out what the heck is going on in your 401k, right? So in the last episode, we looked at the Morningstar investment style box as it relates to stocks and stock mutual funds. Today, we're going to turn our attention to bonds and bond mutual funds. And what the style box shows us is quite different, but it also tells us quite a lot very quickly. So we're going to walk through that today. And let's begin with what you see here on the screen. This is from Morningstar. This is their glossary, which is a resource that I mentioned in the very first video in this series. And we're looking at the style box, and specifically, as you can see, the style box as it relates to bonds. And it tells us two things. It talks about and tells us about interest rate sensitivity. I'll come back to that in a minute. And also credit quality. Let's start with credit quality. I think it's the easiest to understand. A bond is nothing more than debt. When we buy a bond or invest in a bond mutual fund, we are lending our money to governments, to corporations, to municipalities. And the credit quality from Morningstar gives us an idea of whether we're lending our money to folks, to entities that have good credit or not. And the way the box works is the top row would be reserved for those entities with the highest credit. These are the U.S. government, investment grade corporate bonds, think lending money to like Apple or Microsoft, that sort of thing. Absolute top best credit quality, the top row. In contrast, the bottom row would be really below investment grade. So think high yield or junk bonds. Doesn't mean they're bad. But it does mean that the bond fund is investing in bonds from, say, companies or certain governments where there's a real risk of default. They could default on interest payments. They could even default on repaying the principal of the bond. And so they get the lower credit quality designation, and you'll see that in the bottom row. And then the middle row would be for entities sort of somewhere in between. And we'll look at some specific examples. Now, the columns talk about interest rate sensitivity, and this is a very important and in the end, I think a very easy concept to understand, but it can be a little tricky at first. So here's the deal. The value of an existing bond will fluctuate as interest rates change. And that seems kind of odd. You think to yourself, wait a minute, if I buy a bond, let's say it's a Treasury bond and it's paying 2%. If I don't ever sell it, I mean, why is there this notion that it's changing in value? I'll get my 2%, and at the end of the term, let's say it's a 10-year bond, I'll get my money back. Nothing's changed. Well, in truth, the value of that bond is changing every day. Just because we might choose not to sell it doesn't mean that its value hasn't changed. No different than your home. If you owned a home during the 2008, 2009, and thereafter financial crisis, the value of your home probably went down, even if you chose not to sell it. And then eventually it went back up, again, even if you chose not to sell it. Well, bonds are the same way. And the way to think about it is this. If you have a 2% bond, let's imagine you did want to sell it. And you went to sell it, and you found out that similar bonds, brand new ones, that had similar terms, were paying 3%. Well, why would someone want to buy your bond that pays 2% if they could go get an identical brand new bond for 3%? And the truth is they wouldn't. So how would you sell it? Well, you'd discount the price. And so your $1,000 bond, you might sell it for $975. There's actually mathematical formulas to calculate what you would sell it for. But the point is, if interest rates have gone up since you invested in your bond, the value of that bond is going to go down. Likewise, if the interest rates have gone down since you bought the bond, well, the value of your bond is going to go up. If you've got let's say a 3% bond, and similar bonds are now selling for 2%, I mean, people will be breaking down your door to want to buy your bond, and you'll be able to charge a premium. And so that's the real thing to understand is interest rates go up, the value of bonds go down. As interest rates go down, the value of bonds go up. Now, that raises an important question. Just how much does the value of a bond go up or down when interest rates change? And that's where we get to this interest rate sensitivity. Generally speaking, longer-term bonds are going to go up or down more as interest rates change than shorter-term bonds. And that kind of makes sense. If you had a 3% bond and prevailing interest rates were say 2%, and you could sell your bond at a premium, but it matured in 30 days, well, I mean, yeah, your buyer would get that benefit of that extra percent, but only for 30 days. You might get a premium, but not a big one. On the other hand, if you had 20 years left on your bond, well, you might be able to negotiate a much bigger premium because they're going to get the benefit of that extra 1% in interest for 2 decades. So that's really what interest rate sensitivity is measuring. So if the far right column is the one that's highlighted, it means the fund is very sensitive to changes in interest rates, probably means it's a long-term bond. Again, we'll look at some examples. And if it's on the far left column that's highlighted, it's not very sensitive to interest rates, probably a short-term bond fund. And then intermediate-term bond funds, think roughly, I'll say 5 to 10 years, maybe 7 to 10 years, would be somewhere in the middle, what Morningstar calls moderate. All right, enough of the theory. Let's actually look at some examples. And I want to begin with a Vanguard fund. I've just brought it up. It is the long-term Treasury. So Treasury, it means it's a U.S. government bond fund. So this invests in U.S. government bonds. We would expect the credit quality to be sterling. So we would expect the top row to be filled in. And since it's a long-term bond, it's going to be very sensitive to interest rates. And so we would expect the far right column to be filled in. So that would, you put those two together and you can see here the top right column, sure enough, it tells us it's great credit quality and very sensitive to changes in interest rates. By the way, you shouldn't necessarily think of that as good or bad. It's usually a trade-off. Even credit quality is a trade-off. All other things being equal, the better the credit quality, the lower the interest rate you're going to get. Likewise, again, this isn't always true, but generally, the longer the term of the bond fund, generally, the better the interest rates you'll earn. But as you'll see, it's not always quite that simple. So let's take a look at this style box, but a larger version of it. If we go to portfolio, we can see it here. We can see the top right is colored in. Again, that tells us credit quality is excellent, but it's very sensitive to interest rates. And that raises a question. Well, just how sensitive is it? What does that mean? It's sensitive. How about, can we talk turkey here? What's that mean for us as investors? To answer that, I'm going to show you a couple of different funds. Let's go back to Morningstar. I want to compare the Vanguard long-term Treasury to the short-term Treasury. And I'm using the search box that we've looked at before. I think this one will do it. Maybe. Let's see. We'll try here. Yeah, so here, and we'll just go to a portfolio where we can see a larger style box. Again, the top row's colored in. We'd expect that because these are both Treasury funds. They're both investing in U.S. government bonds, so we would expect the credit to be in the top row, and it is. But this is a short-term bond fund, meaning it invests in Treasuries that are shorter terms or shorter duration. We'll talk about that in a moment. And so it's the left column that's colored in as opposed to the right one. So what does that mean in practical terms? Well, we can use something called the effective duration, and you can see it here. It's 18.33 for the long-term Treasury fund, and it's much different. It's 1.89 for the short-term Treasury fund. That number pretty much tells us everything we need to know about interest rate sensitivity, and here's how duration works. As interest rates change by 1%, the value of a bond fund will go up or down by a percent equal to its duration. So for example, the long-term Treasury fund, if interest rates go up 1%, what's going to happen to the value of bonds? They're going to go down, right? So if interest rates go up by 1%, the value of this Vanguard long-term Treasury fund will go down by roughly 18%. That's a big drop. Now, there's good news there. If interest rates go down by 1%, this fund will go up in value by approximately 18%. Now, compare that to the short-term Treasury fund. A 1% change in interest rates affect this fund a lot less, only we'll call it 2% difference. So if interest rates go up by 1%, the value of the short-term Treasury bond fund here will go down by roughly 2%. And if interest rates go down by 1%, the value of this fund will go up by approximately 2%. So you can see now why Morningstar, with its style box, classifies these funds the way it does. An effective duration of 18.33, that's a pretty long-term bond fund, so it's going to be very sensitive to changes in interest rates. In contrast, the short-term Treasury fund, it's only got a duration of 1.89, and so it's not going to be very sensitive to changes in interest rates. It doesn't mean it won't be any changes to its value when interest rates change. It will, but not nearly as much as something like the long-term Treasury. Now, let's talk about how that would affect the actual performance of a fund. If you think about the current climate, and I'm recording this at the end of May 2020. That explains the fact that I haven't had a haircut in three months. I'm calling it my COVID-19 haircut, or lack thereof. So interest rates, even though they've been at historic lows, have actually gone lower as the Fed has tried to help the economy out during, obviously, a very difficult and unprecedented time. So interest rates have actually gone down this year, something that certainly I wouldn't have expected in January. I don't think anyone would have. So we would expect, if we understand the style box correctly, and if we understand duration correctly, we would expect the long-term Treasury bond fund to have actually done very well this year, and the short-term Treasury fund to have done okay, but not nearly as well. Now, I haven't actually looked at the performance of these, so I could be proven wrong, but let's give it a look. All right, so yeah, sure enough, the long-term Treasury, we can see the year-to-date performance here, 20.71%. That's obviously a pretty significant return in just 5 months. And the short-term Treasury fund, I mean, still, all things being considered, I mean, still has done okay, but obviously much, much lower, 3%. And that is consistent with, again, our understanding of interest rate sensitivity and effective duration and the effect of changes in interest rates on the value of bonds. Now, interest rates aren't the only thing that affect the value of a bond. You know, as I mentioned at the start, there's also credit quality we talked about. Obviously, with treasuries, the credit quality is quite high. But let me show you an example of a fund where it's not the case. I'm going to pull it over here. So this is the Vanguard High Yield Corporate Fund. High yield, you may have heard of junk bonds, same thing. And if we go to the portfolio, we will see that the bottom row is colored in, and that reflects the fact that this fund invests in bonds that are issued by companies that are on shaky financial ground right now. Doesn't necessarily mean they'll default, but the risk of default is certainly much higher than, say, a Treasury bond fund. Now, that's not good or bad. In exchange for taking on that additional credit risk, you'll expect investors to demand higher yields, right? So there's always a trade-off, but that's what credit quality means. This is an example of one. In fact, if we compare it to the short-term Treasury fund, we can see that for the Treasury fund, the bond breakdown, almost all of it's AAA, which is a grade that bonds receive. Of course, that's to be expected. This is a U.S. government bond fund. But when we compare that to the Vanguard High Yield Corporate Fund, we can see that this is really BB and B and even below B rated bonds. So much lower and certainly below investment grade. So there's an example of a high yield corporate bond fund where the credit risk is much higher as reflected in the investment style box. Now, as I mentioned, interest rates aren't the only thing that affect the value of a bond fund. If we look at the duration of these two funds, this one's still pretty short. It's not around 2 like the Treasury fund, but it's still pretty low. It's just 4, which explains why the far left column is colored in. But if we look at performance, I suspect it's not done as well as the short-term Treasury, and sure enough, it's down 4.42% year to date. Why is that? Well, our economy is struggling. Businesses are closed. We expect some and maybe many businesses to default. Some probably already have. And so it's a very difficult climate. We're certainly no doubt in a recession, although I don't think you have to wait 2 quarters for that to be officially announced. And so that's going to have an effect on a bond fund, particularly one like this Vanguard High Yield Corporate Fund, where the bonds are issued by companies who were already on perhaps shaky ground before we had COVID-19. So it's not surprising that we see that this fund has lost some money this year. So that tells you pretty much everything you need to know about bond funds and the Morningstar style box. Again, it shows you how sensitive a fund is to interest rates and changes in interest rates, whether it's a long-term bond that's highly sensitive to interest rates or a short-term bond fund that's not. And it also tells you, again, very quickly, the credit quality of the bond fund overall. The top row, high quality, like U.S. government bonds, all the way down to the bottom row, which would be more like things like the high yield bond fund that we looked at here. It could also be certain emerging market governments where perhaps their credit quality is not all that great either. So hope you found this helpful. If you have any questions, leave comments below the video. I do monitor them and will be responding to them. And until next time, remember, the best thing money can buy is financial freedom.